Good afternoon, everyone. Thank you for joining us today. Um, for this month in Finesse, we wanted to talk about something that can be close to home for a lot of us in terms of retirement planning and how we can actually use mutual funds to uh, make this journey of being retired a lot smoother and a lot more effective on the wealth creation side. So, today, we're going to be talking about the power of SWPs or systematic withdrawal plans. And the format of the webinar is going to be similar to what we've done before in the sense that we have a short presentation and then we'll have some time for Q&A towards the end. So any questions that you have, you can feel free to type it into the chat as and when it comes to your mind. And of course, the conversation towards the end will also be a little bit more free flowing. So at that point, if there are more things that you want to talk about, I'll be very happy to have a conversation with you. So once again, thank you all for taking out time from your weekend to come and have this important conversation. And without further ado, let me get started on our presentation. So this is the motivation for doing this was actually that a lot of people who are younger are now managing their parents' retirement money. There are a lot of older people who've never really explored mutual funds as a wealth creation tool, especially in the context of creating a regular source of income, right? And we really feel that systematic withdrawal plans can be very powerful in terms of helping retirees achieve all their goals through a very simple and effective tool. So that's the lens that we are coming from, and we'll look at few different parameters to see how this actually works, right? So to start off with, what exactly is at the heart or the essence of retirement planning? When we really think about this, right, we'll realize that what a retired person really wants is they want a regular stream of income. That's why most of us gravitate towards having like a pension or some kind of interest income that can be predictable and ensure that on a monthly basis, whatever our expenses are, at least there is some level of comfort that we're able to manage those expenses very effectively. Now, retirement can be a very long period of time as well, right? If you retire when you're 60 and you live till you're 85, that's 25 years. That's almost as long as your working life career. So when you see that you have this long stretch of time, you want to make sure that from the beginning till the end, your lifestyle quality doesn't dip, and the only way that we can do that is if we're able to beat inflation. So, this regular stream of income, apart from coming on time month on month, it also needs to beat inflation. So, that's the second objective that we have when it comes to retirement planning. The third and the most, I think, common objective is that people like to have their income tax efficient, right? No matter who you ask at what age category or what income bracket, they're always trying to find ways to save their tax expenses. So you want some level of tax efficiency also built into this core requirement. And the last is that you want to grow assets. So normally what we've seen, because we've worked with people through their entire financial plans, we see that, while they're saving up for retirement, it's always about, okay, let me get to retirement and then I want a steady stream of income. But after retirement, so many goals come up, especially when there are grandchildren involved, or if the children are still in the process of settling down. So there is a need also that even though we are not working, that we still want to grow the assets. We still want to create a bigger pie that can be distributed across generations, right? So these aspirations for a retired person keep changing, and we need to have tools and financial products that help us meet those aspirations. So when you look at these things, we also need to understand what is it that retired people actually prefer, right? They prefer this idea of stability and predictability, right? So when you see that you like something to be predictable, you like something to be stable, you want to know that your income is going to come month on month, typically we are used to thinking in 2 3 year time frames, but we have to extend our thought process, we have to extend our lens and see that retirement actually is a 20 or a 30-year question, right? So when you look at that, the preference for these products like pensions or annuities or interest from fixed deposits or bonds, maybe they might not be the perfect solution that can cater to all those four goals that we saw in the previous slide, right? They help us address some of the things, but not necessarily all of the things. And when we know that there are some things which are left unaddressed, it is our responsibility to go back and see how we can best address those points. So, what is the thing that's holding them back from enjoying what mutual funds have to offer? I think we need to look at the mindset or some of the features of mutual funds that actually can contribute to this sense of fear or discomfort. So, the first is we all know that there are no guaranteed returns in mutual funds, right? There is this standard sort of disclaimer that's there on all mutual fund products, and even for like when you see advertisements, they say that they're subject to market risk. And so you know that there's no guarantee in terms of returns. You know that these investments are going to be volatile. And we don't really have uh, the insight to sort of know which way this volatility is going to be, right? We know that it can go up, it can go down, you don't know when it's going to happen. And so that level of uncertainty actually can be quite um, worrisome for somebody who's retired, because they want that predictability that month on month my income is going to come. I know that if I've saved so much, at least that much is always there, right? That sense of my capital is protected is something that mutual funds don't give us. Then the next hurdle to cross is that it's difficult to choose the right fund, because today we are actually spoiled for choice. There are so many mutual funds, there are so many mutual fund houses, there are so many different ways that you can invest. So there's always this question of, am I doing the right thing? Is this good for me? And then obviously, when you make an investment decision, it takes time for you to figure out whether the performance is happening or not, right? And generally, like if you see, unlike a fixed deposit or a bond, there's no income stream that comes from a mutual fund. You can opt for um, a dividend option or something of that sort, but it's not a regular, predictable stream the way it is with interest income, right? So this means that for a retired person, it's a lot more financial responsibility than they would like. So there are more decisions that need to be made. There are more choices that need to be evaluated. There are more risks that need to be evaluated. So again, this thing of wanting a low risk investment is, now you're questioning whether this is actually going to fit the bill for a retired person or not. So I think these are some of the major roadblocks. These are some of the major pain points that somebody has when they're looking at mutual funds, but they also want that predictable, tax efficient source of income that they would require through their um, retirement years. So now we look at SWPs, which basically an SWP is a plan that allows you to withdraw from a mutual fund scheme on a regular basis. And just to sort of high level compare between the SWP, an FD, and a pension. So whether income is stable or not, in all these products, income is stable, right? Meaning, you know that you can set the frequency in which you get that income, and you can make sure that there is some level of predictability as to what that income is actually going to be. The second point that you want to evaluate is, can you easily access your savings? That is, if you've made an investment today, is it possible for you to tomorrow, if you decide that you want more money, can you easily dip in and get more money? This is possible with an SWP. It's also possible with an FD, but usually there's a cost associated with breaking your FD. So either you might lose the interest, or there might be some penalty that you have to pay for premature withdrawal, right? With pensions, you don't have access to this capital, right? Uh, You only have access to the income stream. So then if we move to the third parameter, which is, can it actually be tax efficient? And with the SWP, we'll get into how it becomes tax efficient a little bit later in today's conversation. But it is possible. Your income can become more tax efficient, or rather, your source of income can be more tax efficient. But with the FT as well as the pension, your income gets taxed as uh, at your slab rate, right? So there's no real efficiency gain that you're having there. Then you come to the question of, can it beat inflation, right? So with an SWP, you can consistently beat inflation. It requires more planning and it requires more coordination and it requires a larger view of your portfolio as opposed to just looking at one single product. With the fixed deposit, from time to time, you can beat inflation. So when your deposit rates are higher than your inflation rate, you are consistently beating inflation. When your deposit rates are lower than your inflation rate, you probably are not beating inflation. With the pension, this is where it gets a little trickier because in the initial years, you're probably beating inflation. But we spoke about how retirement can actually be a 20 or a 30-year process, right? It's not a 2 or 3 year cycle. You have a very long runway for retirement, even once you're retired. So, in the later stages, you could find that a fixed pension actually does not give you inflation beating income, and your income needs also change over a period of time, right? Whereas, like with the FDs as well as the SWP, every few years you have to come back to the drawing board and look at renewing your products and renewing your overall savings plan. So that's a high level comparison. We will get into more details as to what or how mutual funds can create this regular source of income for you, right? So now let me explain what a systematic withdrawal plan or what an SWP actually is. Right. So if you have a systematic withdrawal plan, it allows you to take out a fixed or a variable amount of money from your mutual fund schemes on a regular basis. So you can decide whether you want this income to hit your bank account every month, every quarter, or once a year. Right. So that's up to you. You can say that, okay, maybe I just want a payout for the full year's expenses and I'll keep it aside. Or you can say every 3 to 4 months, this is how much I would require. Or you can say, I like to go with, like, how I've led my life so far. If I was a salaried person, I'd like to see that income every month. So in the SWP, you again have another choice. You can say that you only want to take out your capital gains, or you can say that you want to take out a fixed amount every month. So the second option is basically the opposite of an SIP, right? You're just saying, instead of putting in a fixed amount every month into your mutual fund scheme, you're taking out a fixed amount every month from your mutual fund scheme. So this is the overall context of what a systematic withdrawal plan or SWP is and how you can structure it for your retirement needs. So how can you actually make this concept of an SWP work for you? I think we need to break it down and we need to visualize it in a different way. So we need to have a growth bucket as well as an income bucket. And what happens is, money flows from the growth bucket into the income bucket and from the income bucket into your spendings, right? So every few years, you'll have to look at this rebalancing cycle. You'll have to look at a way of taking some of that growth. We talked about growing your assets as one of the needs in retirement and making that into an easily accessible form of income, right? So when you do this, your growth bucket will typically consist of mutual fund, like equity mutual fund schemes, or higher duration debt mutual fund schemes, or even some direct stocks or portfolio management services. So it's basically investments that are expected to compound over a longer period of time, maybe on 3 to 5 years at a minimum, right? Your income bucket is going to consist of uh, funds that have very predictable returns or at least some level of capital protection. So it can have things like short-term debt funds, money market funds, or even arbitrage funds. And then, of course, your spending is totally in cash, right? So if we look at how we can unlock the power of SWP, I think this is an illustration or a calculation that we've done. So imagine you have a 1 crore portfolio. When you start this plan, 75% of your income will go into the growth bucket, right? Then you have about 25%, which is going to be in your liquid or your income bucket. Of this 1 year's expenses you take and you keep aside, right, which gets spent through the first year. Then every year you draw down from the income bucket to meet those expenses. So this portfolio gets rebalanced on a 4-year cycle. And when you see this, you're able to basically provide for income from 2024 to 2050, which is more than 25 years. And in this period, you're actually able to beat inflation. So if you see every 4-year cycle, your annual spending is actually increasing at the rate of inflation. So we've taken inflation, I think, at about 5 to 6%. And so you can see that you're able to beat inflation and maintain this. And that 1 crore that you started with, you're able to turn that into a spending of 3 crores over a 25-year period. And the return assumptions also that we've taken are at the bottom. So you can see if you look at a 9% growth on your growth bucket and a 6% growth on your income bucket, this is the numbers that you're able to achieve. In today's context, this seems fairly reasonable, especially given that you're trying to catch up with a certain inflation number, right? And this also gives you enough time that every 4 to 5 years you're coming back and seeing whether this plan is working for you or how you can optimize it and make it do better, right? So this is really the power of SWP, that you're able to take your portfolio, you're able to beat inflation, you're able to live a good life through your retirement years, and your income is also slightly more tax efficient than it would be if you were taking out of like a fixed deposit or even a bond or a pension fund, right? So now the key comparison that you want to make, right, is that the FD and the pension, if you had a 1 crore FD today, you're going to get the same payout every year. If you do a 5-year FD, then for the next 5 years, your income is fixed, right? And then at the end of the 5th year, you're going to actually come back and look at what FDs are available at that point and then lock into a long term or a short term FD, depending on where the interest rates are, right? So, but every year it's a fixed amount. And if you're not actually going to compensate for inflation, because today, if interest rates are 5%, then you're going to get a 5% FD. 5 years down the line, if it's 5%, you're still going to get a 5% FD, right? And since your capital is not really growing, you're not able to beat inflation with your original corpus. So, but what happens with the SWP is that you're adjusting to beat inflation over a longer period of time. You can decide to protect your capital also and maintain a more reasonable level of drawdown. So, depending on how you would like to deal with this, you have all of these things working together, right? So, now to move on to the taxation and the tax part of how this works, right? If we look at fixed deposits or bonds, the primary method of earning income is through interest. And the taxation for that is your slab rate. So whatever your income tax slab is, that's the rate of tax that you're really going to pay. So it doesn't matter whether you're looking at a timeline which is less than a year or more than a year, it's the same thing. Now, for pension funds as well, this is the same taxation. It gets taxed as salaried income, and that happens at your slab rate. And similarly, for debt funds, that's the same taxation that you follow, right? On debt funds, the only difference is that only when you incur a capital gain do you actually end up paying tax. Whereas with FDs as well as pensions, since the income is hitting your bank account every month, regardless of or rather in the pension, it's hitting your account every month. With the FD, even if you're compounding and you have a longer term deposit, you're deemed to have earned that income in that particular year. So you are liable to pay tax even if you don't actually get the interest, right? So this is the relative advantage between debt funds. But if you have something like an arbitrage fund, which can also selectively be used to generate income and part of your retirement toolkit, then if you're beyond 1 year, you're paying tax at 10% on your capital gains. And if it's within 1 year, then you're paying 15% on capital gain. So if you look at the SWP, the main reason why it's going to be slightly more tax efficient, even assuming you take debt funds and not an so-called equity tax treatment instrument like an arbitrage fund. The idea is that when you do an SWP, there are units that are coming to your account, right? And this is when we're talking about a fixed amount every month. And when you take these units, the unit contains both your principal as well as your capital gain. So when you're paying tax, you're actually paying tax only on that small portion, which is capital gains. So you're deferring your tax and you're reducing it over a period of time. So on the principal, you don't pay any tax. On the capital gains, you can pay slab rate of 15% or 10%, depending on what you're doing, right? Whereas in the FD and pension, like I mentioned, you do end up paying that slab rate of tax, regardless of the timeline or where the income is actually going. So the key takeaway for somebody who's going to retire is that we actually need a little bit of everything in our retirement portfolios. We can't do this thing of having only debt funds or only FDs or only pension funds. We need a little bit of everything because each asset actually brings in a different element to the table. So if you have broad-based equity funds, it helps you create wealth along with market movements. If you have arbitrage funds, it gives you this added edge of tax efficiency. When you have short-term debt funds, it gives your portfolio a certain level of stability. When you have long-term debt funds, you basically can do some yield enhancement or like better returns because of the interest rate cycle. When you have precious metals, it helps you basically maintain a store of value or beat inflation. And then you have thematic and global funds, which can actually give you cyclical returns, right? In addition to this, if you want to look outside of mutual funds, I think FDs can give you a sense of stability and capital protection, which again, you may not get from a mutual fund. Bonds can give you that similar kind of yield enhancement that long-term debt funds can give you, because if you choose the right bonds, you might earn a higher rate of interest, etc. And there are other, like if you have stocks, again, depending on whether it's broad-based or thematic, you can definitely beat inflation with equity as an instrument. So clearly, there are a lot of advantages to having a little bit of everything, whether it's from the mutual fund side or from another instrument altogether. So when we're constructing the retirement portfolio, we need to think of this in 3 layers, right? So the first layer is basically your income, which should ideally be very predictable. So you can look at short-term debt or arbitrage. So this can be in the form of short-term debt funds. It can be in the form of short maturity FDs. It can also be in the form of arbitrage funds. Or these are the things that contribute to the income portion of your portfolio. If you already have a pension, then that could also fall in here, right? Or if you want some level of stability, maybe you can purchase an annuity as well, which would function pretty much exactly like a pension fund. Then you need stability in the portfolio, because stability basically gives you a sense of continuity and allows you to plan for the next cycle of income requirement. And this predominantly will come from fixed income only, right? And then you have growth, which is required primarily because you want to beat inflation consistently. And so for that, you need an instrument like equity, right? So this is the layer, this is kind of the construction in terms of how you do this. But your growth portfolio can even have a multi-asset strategy, which combines both the stability and the growth requirements. So with this, let me get to the key sort of takeaways from whatever we have discussed so far. So, the first element is that we should use mutual funds for wealth creation because they allow us to compound, they allow us to create that liquidity so that we can take out money uh, as required. It gives us access to our portfolio whenever we might need it as a retired person. And there is that ability to grow over longer periods of time. The second element or the second takeaway that we have is that there is a need to balance stability with growth. Mostly, what we have seen with retirees is that they focus too much on stability and too little on growth, and that leaves them unprepared for dealing with the challenges of inflation or financial goals that can come up in the post retirement period, right? And the third takeaway is that there is a requirement for continuous review. So, the idea of being able to come back and look at your portfolio every 4 to 5 years actually creates more wealth than the idea that you have this one product that will give you income for the next 20 or 30 years. So, when we know that this is basically what we have to do, and these are the key takeaways, I think now we can look at how to sort of implement that over a period of time. Right. So, to help with that, I'd like to talk to you about the two programs that we have. One is Finesse and the other is Milestones to Wealth. So, I'll begin with Milestones to Wealth. The M2W program basically is about taking investors from wherever they are to their first crore, right? And this means that in this entire process, we will handhold you, we will guide you through product selection. We'll be able to teach you things like how we did today in terms of showing you how to use SWPs as a tool during retirement. We'll also be able to mentor and coach you through this process because investing is not necessarily only about product selection and the right fund and this and that. It's also about exhibiting the right behaviors and setting the right milestones for us to stretch and reach. So that's where we're able to add some value. And we're also able to give you a path that allows you to measure what you're doing, right? Because ultimately, unless you measure, you don't know whether you're really doing well or not. So what is the outcome of the M2W program? I think the first is that you learn to be a lot more disciplined with your finances. You develop a growth mindset, which basically means that you're prepared to deal with bigger challenges in life and with your finances and your goals. It also helps you build investment conviction, which is the idea that you have something that allows you to stay the course. And the longer we're able to stay in a particular investment idea, and the earlier we get into it, that's when we are able to actually compound wealth at an incredible rate. You also get wealth maps, which gives you a sense of direction in terms of what are the key action items you need to take to make sure that you're on the right track. So that can be broad based in terms of what kind of investments you need, how much you need to save, what kind of insurance policies you need. So all of this is part of that. And finally, it gives you scalability, which means that it's not about where you are today. Even if you're at 1 crore, or even if you're a much bigger investor than where you are today, you are able to use these tools to get to the next milestone wherever you benchmark that, right? So that's what M2W aims to do. And if you're not part of the program and you want to be part of the program, you can write to us. I think I'll leave the slide with our contact details open at the end. And the last, or rather, the other program that we're running is Finesse. So in Finesse, we have a WhatsApp community, and what we do is we publish monthly outlooks on how the fixed income market looks, what you can do. So for somebody who's retired and who wants to look at the stability part of their portfolio, this can be quite insightful. We also do monthly webinars like this one, and we help investors with product selection, investment reviews, and portfolio construction, which are all an essential part of your wealth creation journey, right? So with that, let me please open up for questions. These are the contact details. So if anybody is interested, do drop in a message. All right. So I think there are already a few questions in the chat box. So I'd like to go with that first. Okay, for financially independent person to make SWP from MF, which MF scheme is suitable for another 25 years? So I think one of the things that I had mentioned is that it's much better to review something on a 4 to 5 year basis, because really no one knows what 25 years later will look like. And I don't think that there is any one fund that you can do. Also, to be clear, like we will not be doing any mutual fund recommendations, or there are no, we are not allowed to give any investment advice on public forums like this. So, if you are an existing client, I'm sure you can talk to our teammates and they will help you uh, pick products that can suit your needs. So the second question is, SWP from equity funds or debt funds is preferable for senior citizens. So that's totally up to you, right? If you're doing so, if you've been an investor for a very long time, I think you can even and you're comfortable with it, you can look at an SWP from an equity fund from a tax efficiency perspective. But the trouble with equity funds is you can have a good month and you can have a bad month, and you can have negative returns at some point. So from what we've observed, many people are not comfortable drawing down from a portfolio where they can't predict what the value would be. Whereas with debt, the progress is a lot more stable and it's more easy to predict which direction it's moving in. So that's the preference for doing SWP from debt. The in-between option where you get equity like taxation and debt like stability is sort of arbitrage funds. But that again, you should talk to somebody before you choose arbitrage, because there are some things that we need to understand about that category, right? That returns are not linear the way they are in debt. So you can have few months of underperformance or no performance. And it is ideally suited for somebody who has a minimum investment horizon of 6 to 12 months. So if you're willing to wait it out for that long in arbitrage, probably after that, there can be some level of portfolio stability. Okay, so there's a screenshot and it says SW tax rate. Why is it falling under both slab or long-term, short-term? Is it not just slab? This is because I think we had shown that you can do SWP from arbitrage as well. So I think that's the logic behind why it's showing in slab as well as 10/15. Because if you take an arbitrage fund, then the taxation for short term is 15 and long term is 10%. I hope that answers the question. How to withdraw capital gains only? This you can actually, like I think in the form itself, there is an option that allows you to select that. If you're working with a mutual fund distributor, they'll be able to point you to the right direction. If you're working with us also, we can help you do that. From a strategy point of view, is it necessary to create an income bucket for SWP, or we can directly do SWP from the growth bucket? Managing two buckets seems cumbersome. So see, this again depends on how large the portfolio is, right? So if your portfolio size is very large relative to your income requirement, then I guess you can just have one bucket. But when it's not, which is actually the case for a lot of people who are retiring today, where they don't really know how much they require, or their income requirements are higher than what the portfolio can sustainably support, then you actually need to have that discipline to segregate the two, and then follow an SWP strategy and rebalance every few months. Also, from a construction point of view, you want to have some part of your investments that you don't touch, right? You need to give them that room to grow. If you're going to continuously take out from them and not allow that growth to happen, then the level of growth can also be different. And ideally, like if this is overwhelming in terms of planning your retirement, I think that's when you should seek professional help, because the most important thing is to make sure that that what you've saved through your lifetime of working is enough for you through your retirement years, right? So there's no harm in getting a little bit help at that point. Yeah, correct. I think Mr. Venkatesh has also answered this very nicely because the risk and returns are different in both the buckets. Growth focuses only on that, whereas the income bucket focuses entirely on uh, just sort of making sure that this. Finesse is just our branding for fixed income. Uh, it's just a program like how we have M2W, uh, where we publish outlooks, where we have a WhatsApp community, where we talk about basically fixed income investing. Because in this market, right, everyone talks about equity, but there isn't enough attention that is given to a safer and a more stable way of investing. So we felt that there is a need to have this conversation regularly with investors so that they also know that yes, there are safer investment options. There are options that allow us to be a little bit more conservative in the way that we're managing our investments. So I think that is the basic idea behind Finesse. What about pension from NPS? Will it beat inflation? So NPS is actually a great retirement tool. If you are still young, you can use that as a savings instrument. Even if you're closer to retirement, I think you're allowed to keep it for a few years beyond retirement as well. So it's a great tool. But any pension is the same, right? Like whether you do it through NPS or you do it through an insurance provider or you get a government pension, the idea is that you're going to get a regular stream of income. Then you have some flexibility in saying that, okay, do you want return of the money that you put in, or do you want something else? Uh, so the income stream is always going to be fixed. Like very rarely do you have a growing pension product, right? So that's this. Okay, so how about annuity products? Annuity products are the same as pensions. The only difference is that I think the pension can be issued by any party, but typically your previous employer. But annuities are provided by insurance company. So this is part of the mutual fund distribution program. So there is no fee for what we do. We do get based on products that you are investing in, we do receive a commission from the mutual fund AMC itself. What about guarantee insurance plan products offering fixed income tax free fully for lifelong, almost 30 to 35 years? I'm not sure what products you're specifically referring to. Do you have a name in mind? I think I've answered the annuity question. So I guess the closest to an annuity plan in MF is the SWP, right? Meaning you get to do that fixed amount, and every few years you can sort of decide to increase or decrease your SWP. Based on ithought experience, what is the safe rate of withdrawal in terms of percentage from a corpus for SWP so that the corpus sustains for 25 to 30 years? I think maybe uh, I think 4 to 5% can be quite comfortable. If you want to do something higher than that, you do need to do extra planning. Like you have to really stretch your resources to make them work for you. So that requires careful planning and coordination. Um, yeah, that is what I would think. To beat inflation as well, because you have to, I mean, like broadly, you have to consider three things, right? One is one part of the portfolio is going to go completely into income generation, which means it's not actually growing, and you're going to spend that down over a period of time. One part of the portfolio has to grow to beat inflation and to refill that bucket, right? And if you're retired or if you're a conservative investor, there's only so much growth that can happen. So depending on your risk appetite, if you're more conservative, then you have to reduce how much you're actually spending on your corpus. If you're less conservative, then maybe you can be a little bit more aggressive, but not really very aggressive on the growth bucket. So arbitrage is a category of mutual funds where there is net no equity exposure. So you have, let's say you're buying a stock, you'll buy an offsetting position in the futures market. And so net there's no exposure, but there will be some little bit of like price differential, and that's how the fund makes the return, right? Um, okay. Hi, let's consider I have a home loan of 20 lakhs and I have cash of 25 lakhs. Can I move to SWP and regular income pay EMI? Yes, you can. If that is something that you want to do, you can use the uh, cash. You can put it into a liquid fund or and then do an SWP to sort of repay your EMI. Yes, the recording will be available on our YouTube channel. So if you are following our pages, you should be able to access it as soon as it's out. All right. So I've answered this question for alternative for annuity plan and MF. What is the minimum amount to put 35K? I would need to run this through the calculator, but I think you can just do that, right? Like if you want, if you assume a 4% payout, what is which is equal to 35,000 into 12, then I think you should be able to get that answer. I have two questions. I'm investing in solitaire PMS to grow the corpus for my retirement. At the time of retirement, will you use the equity corpus to buy MF and then do SWP from there? Is there a mechanism by which assets in one equity PMS can be transferred to another without incurring tax implications because you are not withdrawing anything? Okay, so I will answer the first question. So, yes, probably at the time of retirement, it depends again on what is required. So, either one, if it's possible to do it from within the portfolio itself, and that was what we were talking about, right, in terms of the size of the portfolio versus the income requirement, then that would be one option. If that option is not feasible, then probably we'll have to take out some money for a few years, keep that in mutual funds, and then do an SWP. That is one thing. The second is there a mechanism by which you can move your investments from one PMS to another? I think this will be difficult because ideally, like the two don't have the same mandate, right? Which means there has to be some level of selling and buying that happens. And in that case, that will trigger capital gains or capital losses, as the case may be. Okay, so I'll just come to the question on capital and units on taxation. So this is fairly simple, right? Like if I put in 100 rupees in a mutual fund and I get 10 units, that means I've bought it at an NAV of 10 rupees. Now let's say over a period of time it grows to 10.5 rupees. Then each unit is worth 10.5 rupees. So when I sell one unit, I'm actually selling 10 rupees of capital and zero point 0.5 rupees of capital gains. So on that 0.5, I have to pay tax. On the 10 rupees, because it's my original principal, I will not pay tax. I hope that is uh, clear for you. Regarding tax for SWP, the slide said that for capital gains slab 10, 15. It's not very clear. Can you please explain a bit more? Yes. So for the capital gains, right, if it is a debt fund, you will pay slab rate because that is now the new taxation. If it is an equity fund or or if it has equity taxation, so certain hybrid funds, etc., would qualify as equity funds, right? In which case you will end up paying 10% if those units are long term, which is held more than 1 year, or you will end up paying 15% if that unit is short term, which is if you withdraw within a year. I hope that solves your question. So do we have any more questions? Anything else?
Just one came in right now, Sam.
Okay. So not liquid funds, but invested in MF, etc. today. Can SW start immediately from next month? Uh, Yeah, I think, see, there is usually like a 1 month timeline, I guess, for starting any sort of transaction or stopping any transaction. So I think that's a reasonable timeline to have. There's no minimum number of years to start an SWP, right? That depends on your requirement. Ideally, like depending on how much you've put in, that can sustain only for X number of years. So then that would be the, I think, main criteria. Or sometimes what we've had is like somebody is not sure the next 1 year if they take like a sabbatical or they're looking for a job, they might want to do an SWP for a short period of time, and that is possible through the mutual fund route. And then of course after that time ends or in between, if there's more clarity, then you can sort of change what you're doing at that point. Okay. So this next question from YouTube. Can I please know what are preferable hybrid mutual fund categories if I plan to invest as a lump sum, wait for 3 years and start 6% SWP? Should I be worried about timing the market? Uh, so I think hybrid is not something that as a fund house we're very positive on, because the hybrid category only gives the fund house a mandate on how much they should have in debt or equity. But there are other important factors that we think should go into portfolio construction, which is, let's say, what is the quality of the debt component of the hybrid fund, or what is the kind of duration call that the hybrid fund will take, right? Similarly, for equity also, you want to know what is the market cap restriction, or like what is the quality of the portfolio, what is the style of the portfolio. And hybrid really doesn't give you too much insight into these elements, right? So from our house perspective, ideally, if you can separate your debt and your equity, nothing like it. The key advantage that you have in hybrid is the tax part, right? So I think that's the main advantage. And if that is more important to you than these factors, then I think whichever, depending on how much equity or fixed income exposure you want, you should look at hybrid as a category. So if you want more equity exposure and less debt exposure, you could look at the aggressive hybrids, or you could look at multi-asset funds or dynamic asset allocation, or multi-asset funds. If you want less exposure to uh, equity, then you can look at conservative hybrid funds. If you want something that goes according to the market cycle and that has more flexibility, then you can look at dynamic asset allocation. If you do STP from equity to liquidity, what is the tax calculation? It's the same. So that one table that I shared with you, right? You just need to see what is the tax rate that is applicable. And if you're doing STP from equity to liquid, you will basically, again, it's the same logic as the SWP, right? Whatever is capital gains, you will pay either short-term or long-term capital gains on that. Whatever is principal, you don't pay any tax on that. Okay. How is our fund safe with you if your company is shut? Sorry to ask this. This is my long time doubt. This is actually a good question. So we are a mutual fund distributor, right? So let's say I choose 5 different funds for you, and they are with ABC Fund House, DEF Fund House. Even if I thought is no longer in the picture, the money is invested with the mutual fund house. So it's always going to be there, and this industry is regulated by both AMFI and SEBI. So whether we are there or not there is not important, because at the end of the day, the money is never transferred to ithought or ithought MFD at any point. It's always in your account, in your name, with your PAN and with your folio details, right? So it's always going to be your money. That will never actually change. Even in the instance where a fund house has shut down certain schemes, and we saw that during COVID for some fixed income funds, the money has been returned over a period of time to investors. So I don't think there has been any situation where you have to think that, okay, if you put the money, then it disappears. That doesn't happen. But like I said, mutual funds are market linked instruments, which means the value can go up and down on a day-to-day basis. So in the mutual fund, how taxation is calculated for hybrid fund for short term or long term gains. So again, it depends on the category of the hybrid fund, because basically for conservative hybrid, I think since it's predominantly debt, it gets taxed like a debt fund. For the in-between hybrids, there is a separate taxation of 20% with indexation. Then you have the more aggressive ones get classified as equity, so the taxation will be like equity. So depending on the category and the net equity exposure per year, the taxation will actually change. Uh, which table are you referring to? So for long-term debt allocation, arbitrage or money market fund, which is suitable for senior citizens. For long-term debt allocation, these are not suitable at all, whether you're a senior citizen or a younger person. Long-term debt allocation would require some level of uh, exposure to other categories, right? So you can have uh, either duration-based debt funds, or you can have open-ended categories like banking and PSU or corporate bond or credit risk, or you can even do dynamic bond funds. So for longer term, you need to look outside the 1 year bucket. Right. I think, okay, so one more question. In the growth bucket, will you use STP method to increase the return reward before moving the investor bucket for SWP? So STP is basically a tool when you want to manage market volatility, right? And yes, you can use that in the growth bucket also. It doesn't mean that you can't have liquid in the growth bucket, because sometimes if the market is overheated, you do want to be a little bit more careful with how fast you're getting in. Yeah, there's nothing wrong with managing SWP with just simple or liquid or money market funds. If it's if it's what you need at that point. So liquid is better in terms of predictability of returns. Uh, Arbitrage is better in terms of tax efficiency. So it's just up to the investor what is more important to them, right? I don't think that one is better than the other, or that there is only one right answer. It's about what works for you. At the end of the day, this is your retirement corpus. You do need to decide what is the most appropriate. Thank you. It's very nice to hear that this was useful. If you have any suggestions on topics for future webinars, please let us know. I've also left our contact details here, so you can drop in a message anytime. Yes. Yes, credit risk. See, credit risk works in a very specific context. It cannot work all the time, and in the mutual funds are also not the right tool in which you can take that kind of credit risk. So, thank you. Thank you everyone for attending. Yeah, I think a lot of people are leaving, so I'd just like to say thanks once again for taking the time out and coming and having this conversation. We look forward to having you next time. Please do write to us if you have anything on your mind and if we can be part of your wealth creation journey. So we can do, I think Harshil has done a webinar actually on arbitrage funds. You can learn more about that from the YouTube channel itself. I think that webinar is also available online because it's a little bit detailed, and I think if I had some visual tools, I'd be able to explain it better. But the idea is that you have there is some difference in pricing between the spot and the future market, right? So the spot is where you directly own shares, and future is like you have a contract to buy or sell in the future. So when there's a difference in price, if you're able to somehow buy and sell at the same time so that you earn the difference in the price, that is how you get the arbitrage return. I uh, I hope that is helpful. If not, like please do watch that webinar because he has done a good job in explaining what arbitrage funds are and how you can use them. All right. Thank you, everyone. I think, Tarun, if we don't have any other questions, maybe we can close for today.
Yes, Sam, we don't seem to have any other questions. Yeah, we can close for today.
Okay. Thank you.
Thank you all. Thank you.